2014, 2013 have been pretty significant staging points for the UK mortgage market the last couple of years. Really following the financial crisis in 2007, 2008, the market pretty much plummeted to the point where gross mortgage lending was down around 130, 140 billion pound mark for a number of years. The last couple of years have seen significant growth. 2014 in particular, the gross market was around 206 billion pounds. That was around about a 30% increase on 2013. And the expectation is for 2015, this year, that it might go as high as 225. On a personal level, I think that's a little optimistic, based on sort of what my colleagues were talking about earlier in terms of stock levels, in terms of property transactions, which may emanate from that. But the market is definitely on an upward trajectory, and buy-to-let is certainly playing a pretty big part in that. If you can just sort of ignore the narrative a little bit on the right, this gives an indication of what's been happening in buy-to-let terms over the last 7 or 8 years. So 2007 was the peak of the market in every sense. You probably have heard stories around things like self-certification mortgages and so forth. That's all been and gone, and that was what really triggered the real growth in the mortgage market up until 2007. Following that, 2008, we saw the demise of things like Northern Rock, the nationalisation of HBOS and Lloyds and so forth, and really lending, and particularly buy-to-let lending, went into an absolute, effectively, sort of hibernation, to the point where in 2009, as you can see from the graph, it was less than £10 billion, whereas only 2 years earlier it had been £42 billion. So we've seen some pretty steady growth over the last couple of years, to the point in 2014 where it was actually £27.6 billion. And again, around a 30% growth against 2013. Now, expectations are, as the guys have already talked about, that we will see continued growth. I think demand is definitely out there from a landlord perspective. I think expectations are this year the market could go above £30 billion, which actually, relative to last year, means that buy-to-let is now around about 13% of gross lending. So quite significant. And again, reiterating what my colleagues have said earlier, the private rented sector is currently 19% of all the housing stock in the UK. Savills, who are very sort of frequent forecasters in the marketplace, are suggesting that the private rented sector could grow as far as 25% within the next 10 years, which it gives you some indication of how much further the market has to go. As I said, 32% growth last year. The economic environment, as we would say, very much supports buy-to-let in the sense that although the mortgage market has freed up, there are now more products available for first-time buyers again. So some of the barriers to entry are no longer there. But what we've got is quite a big sort of change in terms of sort of socio-demographics in this country. People historically, and dare I say people of my age, I bought my first home when I was 23. A lot of people now, they're far more going to university. They're coming out of university often saddled with massive student debt. Perhaps earnings are not as great relative to perhaps where expectations were. And in many instances, in order to access the housing market, people are reliant on often parental contributions. And since the financial crisis, the availability of high loan-to-value mortgages has not been as great. So people obviously have to live somewhere, so the private rented sector, to a large degree, has stepped in and filled that void. So effectively, a lot of what would have been first-time buyers traditionally have become the tenants of landlords. And I think that is going to continue for the foreseeable future. The other thing, as I touched on earlier, in terms of where the market has contracted and then increased, is lender appetite in the market. So if we go back to the peak of the market, there were a whole raft of different brands out there who were offering mortgages in 2007, early 2008, many of whom have left our shores now. A lot of them were US-based banks who set up operations in the UK, often only available through what was called packaged operations and through intermediary distribution. Once the markets collapsed, the securitisation market in particular, many of those lenders shut up shop and moved away. As the market has improved and funding conditions have improved massively over the last 3 or 4 years, lenders have regained their appetite, as you saw from the previous graph with the growth in volumes. And what we've also seen is a big resurgence of lender brands, many of which you'll be familiar with on the high street, who have entered the buy-to-let market. And I'm talking not only in terms of people like BM Solutions and the Mortgage Works, which are 2 of the biggest brands in the UK, and some people here may have mortgages with those organisations, but some of the other, let's say, more mainstream high street brands, including people like Santander and Accord Mortgages, which is part of Yorkshire Building Society, they've also actively got into the market. And the reason for doing is it's relatively low risk, because generally most lenders are only lending up to 75% loan to value, generally. In many instances it's 60%, so there's a huge amount of equity that the customer's putting into. The rates that they can charge for buy-to-let, although extremely competitive, are still higher than residential, so margin is very good. And actually what's interesting is that if you look at arrears rates, and this is a key thing from a lender's perspective, the arrears rates on buy-to-let lending are actually less than on residential. Now some people might be surprised about that, because as my colleagues here said earlier, you have to divorce yourself from the fact that it's not your home, it is a business investment. But in reality, most landlords are very keen to ensure that their mortgages are paid. Even if, for instance, their tenants aren't paying, they will, in many instances, they will make every effort to ensure that their mortgage is up to date. Because for most people, they want to grow their portfolios and expand and borrow more. And of course, if you've got credit impairment against you, it's not impossible, but it's more difficult. So growth in brands is quite important. We think at the moment, sorry, think sounds a bit vague. There are around 45 different brands active in the buy-to-let mortgage market currently as we speak today. And in terms of product numbers, there's over 850 different buy-to-let products out there. That's an increase from around 600 only 12 months ago. So that gives you some indication of how the market is really starting to move on. What's driving supply and demand? Really interesting stat on the left-hand side there. It's projected that our population in the UK as a whole is going to rise by something in the region of 10 million people between 2012 and 2037, which is a 25-year period. That's massive. Now, we are building around 130,000 new homes a year currently. That's been the sort of current run rate for a couple of years, and that's improving relative to where it was. But we are constrained by capacity. Although the planning laws have been changed and planning applications are at all-time highs, there are over 200,000 planning approvals last year, we are lacking capacity both around tradespeople and materials. And even if we get up to the sort of, let's call it politically talked about levels of house construction, 200,000+, we are still massively behind the curve relative to where we need to be. And that's just based on population today, never mind where population is going. And that's driven by an increase in one-person households. So a good thing to say is we're all living longer. My mother's just passed away, she was 93, but she was living in her own home until the last 6 months of her life, in a 3-bedroom home. She didn't need to be in that, but she wanted to be in that. So that sort of stock is not coming back onto the marketplace. We have one of the highest instances of divorce and separation in Western Europe. So again, where a couple become two singles, that invariably involves one person moving out and perhaps renting a property, particularly if they don't want to disturb the family unit and keep the existing mortgage going. And as we said, net migration, which is currently running at around 250,000 a year, is going to continue. And with EU laws and so forth, that's only going to increase. What is it that people are attracted to? 8% of the UK population are currently considering buy-to-let as an investment. That's a pretty staggering statistic. And part of the reason for that is that people see it as a pretty good bet because of some of the data we've already talked about. Savings and investments are pretty much on the floor, as was alluded to earlier. People have not got the investment returns from traditional products that they might have enjoyed in the past, and that's not likely to change anytime soon. People have not perhaps been able to invest the monies into traditional things like pensions and other savings and wealth type products that they might have done had they had the cash. And even where they have done, the returns have not been perhaps as they would have expected. So people are looking at property as a way to augment their income and in particular their retirement. And actually a lot of people, more than a third, have actually said in surveys that they would rather invest in property than they would in a pension. And a lot of people have not actually even considered investing in a pension. And even at 30s and 40s and even the 50s, a lot of people have very, very limited pension funds. And although we're going to touch on a couple of things around pensions in a short while, you might be surprised as to some of the numbers. Nearly 3/4 of landlords intend to use their buy-to-let properties to support their pension. And 1 in 3 existing landlords plan on increasing their portfolios in the next year. And actually, surprisingly, and obviously Manning Stainton obviously here as letting agents, but actually only a half of all landlords in the UK use letting agents. A lot of people do self-manage, but obviously there's a lot more risks involved in doing that. So if that's something you're considering, there are even more pitfalls that you need to perhaps consider. And again, these guys can get a value of those. So what's changing in a legislative perspective? I'm not going to bore you too much around some of this because some of it's quite detailed, but as Peter, I think, referred to earlier, we've had some significant mortgage regulation on the residential side in the last 12 months, the mortgage market review. That didn't directly affect the buy-to-let market. It only affected residential mortgages. But what it's effectively meant from a borrower perspective is that the three principles that I suppose we could describe here. All mortgages effectively now must be on an advised basis, so people can't just go in and self-select effectively, except a very, very small group of what is termed high net worth customers. Mortgage lenders have to absolutely demonstrate that the mortgage is affordable both now and in the future, and they have to ensure that the customer is stress tested in terms of affording that mortgage if and when interest rates rise at some point in the future. And the third thing, I can't quite remember, it's gone completely out of my head, but I'll come back to it in a second. FPC guidance, the Financial Policy Committee have placed much greater strictures around lenders, and that's around things like what is termed capital adequacy. So for instance, where if a lender is lending to, say, first-time buyers who typically require higher loan-to-value mortgages, lenders as a consequence have to put aside more capital in terms of risk to offset any future losses that those loans might generate. So what lenders are looking to increasingly do is to divest themselves from some of that risk, and they see buy-to-let as a very good option because, as I said earlier, it's lower LTV and the returns are better and they can charge more, and therefore their margin is greater. The pensions rule, as I touched on earlier, is I think I'm no expert on pensions, but in terms of the broad guidelines, what will happen from April next month is that effectively when you have a personal pension, you will be able to actually take that pension fund and pretty much do with it what you will, within reason. So at the moment, if you have a personal pension, you can take up to 25% of the fund as tax-free cash. After April, you will effectively be able to take the full fund, of which 25% will be tax-free, but you will pay a higher rate of tax on the balance if you choose to do so. Now, there is a thought process that some people think that a lot of would-be pensioners or people taking their fund will rush in and buy in the buy-to-let market. Personally, I don't think that's the case, and I think most people would be genuinely wrong to do so. And you might think, well, why would I think that? You know, that's just more business. But the reality is, personally, I think everybody should take retirement planning advice from a suitably qualified advisor. And it may be for some people that property or part of their investment should be invested in property, but only having considered the wider options in the marketplace. Base rate increase is not obviously a legislative change, but it can have an impact in terms of affordability, clearly. And these are some of the sort of things that, again, the Financial Policy Committee, the Monetary Policy Committee, and all these things tend to worry about. Because any increase in base rate will put stress pressure on some households, and it will put stress pressure on some landlords as a result. So all of these things are thought through very carefully, and the impact that can potentially have on the marketplace. And the last thing, consumer buy-to-let, which I'll touch on, is also linked to the first point, which is the EU directive. Now, I talked about the mortgage market review, which is UK legislation, but there is another piece of legislation which is going to hit our shores next March, which is called the EU Mortgage Directive. And this is our friends and colleagues in Brussels who are bringing about some further changes to mortgage regulation. Not much of it is actually going to impact on us relative to some of our continental cousins, because we have a higher level of regulation than most of our European colleagues. But it will have a small impact on one sector of buy-to-let, which is what I just wanted to talk about. And that is that currently, if somebody is selling their main residence, or sorry, somebody is going to let their main residence because either they can't sell it or they don't want to sell it, so they're going to let it commercially and then buy elsewhere as their main residence, that loan will be treated as a regulated contract in the same way as a purchase or remortgage today is treated as a regulated contract. But if you are buying a property for investment only, or for buy-to-let purely, it will still be an unregulated product moving forward. Now, the EU were, in fact, our Treasury fought very long and hard to actually ensure that buy-to-let, as it stands, can continue in the way that we currently enjoy it. Because the EU Council, Parliament, wanted buy-to-let to be conducted on exactly the same basis as residential mortgages, i.e. to be assessed against personal income, not against rental income. And that probably would have killed the market if it would have been gone through. But the Treasury in the UK fought very hard, explained the way that buy-to-let works in the UK, and that was the compromise. So any customer who's got their main residence today and is planning on letting it and buying somewhere else to live in, that will become a regulated contract. But anything you're buying from a future purchase perspective as an investment will remain as a non-regulated contract moving forward. I just want to talk a little bit here just about overall product appetite here. Again, I talked earlier a little bit about how the market had contracted, lenders' attitude to risk had massively decreased, and we've seen quite a substantial reversal in that. So it's fair to say at the moment, if you are a first-time landlord, there are plenty of products out there which can meet your needs and requirements. So landlords are keen for first-time landlords, subject to certain checks and balances. Some lenders don't require that landlord to have what we term as a minimum income. Now, going back a couple of years, it was never required in 2005, 6, 7 to see a minimum income of a landlord. But following the credit crisis, lenders became very cautious. And then subsequently what we started to see is higher levels of minimum income creeping in to the point where some of the new entrants had 25, 30, even £35,000 minimum incomes. Hello? Sorry, it's gone. Before they would actually consider lending to people. Now that income would not be rental based, that had to be secondary to rental income. So that effectively precluded a lot of people from the market. But again, as the market's improved, so lenders' strictures have reduced, and there are now a number of lenders out there in the market who don't require to see a minimum level of income. Okay? One or two also have no upper maximum age. Now what they will have is a maximum age at entry, and I'll give you an example of that. There's a lender called Precise Mortgages, which again is an intermediary-driven only lender. They will allow somebody up to the age of 79 to take out a new mortgage, but it must be repaid by the age of 85. Whereas the Mortgage Works, which is part of the Nationwide Group, very large buy-to-let lender, they have a maximum age at entry as age 70, but they have no upper age limit by which you can have to repay the mortgage. But many lenders do have an upper age limit of, say, 70, 75, or maybe 80. So there's lots and lots of different factors in the market that you need to be mindful of. I personally think that's a bit of an anathema, because a lot of people, as I said earlier, are investing in buy-to-let to augment and supplement their pension incomes. And of course, when are you going to need that income? In your retirement. So if you're at 75, you won't necessarily want to have to sell your property because you've reached the maximum age to which the lender wants to lend to you. You obviously want your loan to go on in perpetuity until such time as either your death or you perhaps go into some other form of housing. But the reality is, such is the way that the market is currently structured. A lot of lenders do have specific age-related issues which you need to be mindful of. The market has also expanded. I think people touched on earlier a little bit about sort of student markets and things like that. HMOs, houses of multiple occupation, it's a specialist part of the market. We're starting to see, again, a little bit more appetite from lenders who are prepared to move into what we would call the more specialist sector. So HMOs being one, multi-unit properties, and properties which are managed under limited company propositions. I mentioned earlier there's around about 45 lenders active in the market, but if you're looking at investing in property which is more in that specialist sector, your choices will not be anything like as great. You're probably looking at maybe 8, maybe 10 lenders perhaps who have got any appetite for that. So your range of product options comes down, and clearly, like everything with supply and demand, as your product options reduce, so the price goes up a little bit as well. But if you're in the HMO market, you will probably enjoy a greater yield as well. In terms of LTVs or loan to values, what proportion of the mortgage relative to your property value, the maximum you're going to get in the market at the moment is around 85%. But as I said, the majority of products are structured around two loan points. 60% is probably where you're going to get the best pricing, and 75% is the norm. There are a few that are operating at 80, and 1 or 2 only operating at 85%. But if you're borrowing 85% of the property's purchase price or value, you've got to generate a pretty significant rental return to make your rental coverage. And again, I'm assuming here that the way buy-to-let works in very simple terms is that most lenders require a rental income to be at least 125% of your mortgage interest payment. Okay, that's the broad rule of thumb. Some of the lenders will calculate that or apply that stress rate based on what we call the pay rate itself, so what you're actually physically paying on an interest rate. But but most do it on what we call a notional rate, and those notional rates are typically 5.5, or even 5.996%. If you're going for a 5-year fixed rate, and again, we're starting to see more and more landlords opting for longer term products, and I'll come on to that in a second, then they don't stress test in quite the same way. So if you've been fortunate enough to buy a 5-year fixed rate, perhaps with a 4% around, somewhere around that 4.5%, you can actually get your rental count to work on that 4% basis, which means that you've probably got more greater margin, and the lender's not having to stress that. And where I've talked about no maximum number of properties, again, pretty much all lenders will have what we call a property portfolio exposure that they will only want to take on. So if you had a new landlord, or any landlord, let's say they've already got 4 or 5 properties, if they were all with one lender, let's say, for instance, again, Precise Mortgage, as I mentioned earlier. Now, I think Precise will take up to 7 properties with one client. Other lenders are not quite as accommodating as that. So, for instance, Lloyds Banking Group, as they currently are, if you remember, they absorbed the old HBOS operation, which incorporated brands like BM Solutions, Intelligent Finance, the Mortgage Business, 2 or 3 others, which name escaped me, plus Cheltenham and Gloucester and Lloyds themselves. Now, that brand, well, if you've got 3 products with them today, they won't allow you to have any more. New business. So what a broker will have to do is to determine, if you've got existing properties, who your current mortgages are with, and what level of exposure you have with each lender. But most lenders in the market are not concerned with how many properties you've got within your entire portfolio, and that's quite a good thing. So that gives you plenty of options. And what we're starting to see as well in the market is we're seeing some new brands come into the market, as I talked about earlier, which therefore is increasing the overall scope of the market. So in the last 6 months, we've seen a company called Fleet Mortgages come into the market. Again, not a brand you probably would have seen, you certainly wouldn't have seen them on the high street, because they're what we call a centralised lender that only distribute their mortgage products through intermediaries, through brokers such as ourselves. Other brands, I mentioned Santander earlier. Now, obviously, Santander, big high street brand, but they don't sell buy-to-let mortgages through their retail outlets. They only distribute buy-to-let mortgages through brokers. And the same applies for a number of other lenders out there as well. So at the moment, if you take the overall mortgage market as a whole, it's estimated that around 65% of all mortgages are transacted by brokers, and therefore 35% are transacted through branches. But in the buy-to-let arena, it's estimated that nearly 90% of all mortgages are conducted by brokers. So if you're thinking, I'll walk into the Nationwide on the high street, or Santander, as I mentioned earlier, you're probably going to get a polite thank you, but we don't do those. You need to go and see a broker. So obviously, working and acting for a broker, I would always advocate, seeing that broker in there, because a broker is independent, will act for you, the client, and look across the entire marketplace. Last couple of things, I'm just conscious of time. I think my colleagues have already really sort of touched upon this. The key thing, obviously, is to do your research: location, property, price, yield, and risk. Again, bearing in mind all those points I've made around things like rental calculation. The other thing you need to be mindful of as well is that 1 or 2 lenders do have minimum property valuation requirements. And again, some lenders will have a minimum loan size, for instance, of, say, at least £50,000, often in the buy-to-let arena. Some it might even be £70,000. That's not always the case, but so therefore there might be certain properties in certain areas that some lenders won't go near. So you just need to be mindful of that as well. And of course, if that's the case, that reduces your options. Lastly, I think, again, we've just touched on this in general terms. You need to think from a personal perspective how you want to actually own the property. So most people, the majority of properties that are owned in the private rented sector are owned by individuals, but we're starting to see more properties being owned within what we call limited company structures. And again, this is people that have set up a limited company purely for the purpose of managing property, which can have some significant tax advantages, which I'm not going to go into, but one of my colleagues on the panel may well. And also, but again, you need to be mindful there that once you do that, your choice of product is currently going to diminish, and probably will stay diminished for the foreseeable future.